The shock hit before officials could react. At sunrise, a structure the size of a skyscraper drifted into Lake Maracaibo, so quietly that soldiers on shore didn't realize what they were seeing until its engines shut down. It was China's Alula platform, a billion-dollar machine Venezuela was never supposed to receive under United States sanctions. Within minutes, satellite alerts triggered in Washington, and analysts realized the nightmare scenario had arrived. China wasn't just buying Venezuelan oil anymore. Beijing had just moved in to rebuild the entire industry. The timing collided sharply with a new sanctions offensive from Washington. Hours before the Alula reached its anchoring point, United States President Donald Trump announced a renewed package targeting Venezuelan aviation, security ministries, and PDVSA leadership, including Telechia. The order included a threat of 25% tariffs on imports from any country continuing to purchase Venezuelan crude, a clause aimed implicitly at China. Yet as Trump issued the warning, Chinese technicians already surrounded the Alula's control systems, preparing to restore wells that had been abandoned for lack of capital and equipment after the sanctions regime escalated. Bloomberg confirmed that the platform had been transported across the Pacific to revive two key fields, Lagunielas and Lago Cinco, both in the Maracaibo Basin and both central to Venezuela's oil identity. The stakes tied to these fields have been documented by American geological surveys, showing Venezuela possesses more than 300 billion barrels of proven crude reserves, the largest on Earth. But reserves meant little when extraction collapsed. Sanctions froze PDVSA bank accounts, blocked access to rig components, and prevented companies from selling Venezuelan crude in United States markets. The Wall Street Journal reported that PDVSA lost $11 billion in 2019 alone because of asset freezes and export disruptions. By 2021, national output fell to around 500,000 barrels per day, according to OPEC's secondary source data, a historic low for a country built on petroleum revenues. Inflation surged into triple digits. Food imports fell. Blackouts spread across industrial regions, including Zulia state surrounding Maracaibo. China entered this landscape not as a rescuer, but as a long-term strategist. Xi Jinping had already elevated energy security as a national priority, and Venezuela's heavy crude complemented Chinese refinery configurations built over 2 decades. According to Bloomberg shipping records, China imported an average of 350,000 barrels of Venezuelan crude per day in 2024. Much of it routed through Brazil or Malaysia to reduce seizure risks. Reuters confirmed that by early 2025, 90% of Venezuela's crude exports went to China. This represented a geopolitical inversion. The sanctions intended to isolate Venezuela instead consolidated its dependency on a single partner willing to accept discounted barrels in exchange for long-term access and political leverage. Settlement patterns really amplified that shift. The Wall Street Journal detailed that in 2024, 72% of China-Venezuela crude transactions were settled in renminbi, bypassing US dollar channels that could trigger asset freezes. By early 2025, the share stabilized above 65%. IMF analysts said this demonstrated how sanctioned states may adopt alternative currencies, not out of ideological preference, but out of necessity to sustain export flows. For China, the pattern strengthened the renminbi's legitimacy in commodity trade. And for Venezuela, it provided some breathing room after years of financial suffocation. Maduro received updates throughout the morning as Chinese and Venezuelan engineers initiated diagnostics across the Lagunielas field. The field's geological significance is, honestly, extraordinary. PDVSA surveys cited by Bloomberg show it has produced more than 7.4 billion barrels of crude since discovery, with an additional 1.8 billion barrels of technically recoverable reserves. Total oil in place exceeds 43 billion barrels. Lago Cinco, positioned offshore within the lake, historically produced light crude that once commanded premium pricing. But sanctions cut the field off from essential parts, forcing PDVSA to idle wells, shut pumping stations, and, well, watch its own infrastructure corrode. The workers who gathered along the shoreline that morning did not speak about geopolitics. One mechanic told Reuters he simply never expected to see a working platform on the lake again. His father, a former PDVSA electrician, had retired early because the company lacked the parts necessary to repair drilling equipment. He said the day the Alula's lights illuminated the water felt like the moment Venezuela stopped collapsing and began resisting. No speeches could really replicate the meaning of that return of industrial light across the surface of a lake long associated with loss. The technical revival moved quickly. United Resources Group, a Chinese private energy firm working under a 20-year operating agreement with PDVSA, deployed roughly 300 specialists to restore the two fields. Their tasks included reopening old wells, drilling new ones, recalibrating pressure systems, and repairing flow lines. Bloomberg confirmed that by mid-2025, the combined daily output from the fields had reached 12,000 barrels per day, consisting of both heavy and light crude. The heavy grades flowed to China under long-term supply contracts, while the light crude supported Venezuela's domestic refineries or served as blending stock for export. Production decline forced Venezuela to blend its heavy crude with light imports, increasing costs and reducing margins. By rehabilitating Lago Cinco, Venezuela regained access to its own light crude stream, improving export flexibility and internal economic efficiency. The Puerto La Cruz refinery embodied the long-term arc of China's involvement. Beginning in 2013, Chinese engineering teams spent 47 months modernizing the aging complex, replacing outdated distillation units and upgrading safety systems. When the renovation finished, capacity reached 210,000 barrels per day, a 17% improvement that Venezuelan officials described as a recovery from near ruin. Technical reports cited by PDVSA indicated that accidents and shutdowns decreased sharply after the upgrade, stabilizing the domestic supply of refined products. While that modernization receded from headlines, it set the stage for the current expansion. Maduro used the refinery as proof that long-term collaboration with China yielded tangible results even under sanctions. Pedro Rafael Telechea emphasized that PDVSA had restructured its operational units around joint planning models with Chinese engineers, allowing for more predictable output and more efficient resource allocation. Analysts quoted by the Financial Times said this operational consistency was impossible under earlier sanctions-era isolation. Trump's sanctions re-entered the narrative with the force of a geopolitical counterpunch. The 25% tariff on countries buying Venezuelan oil aimed to disrupt intermediaries, particularly in Latin America. Countries such as Brazil faced compliance dilemmas because their refineries had historically processed Venezuelan grades. Joe Biden's previous relaxation under General License 44 briefly allowed PDVSA to restart limited trade with foreign companies, but that window closed as soon as Trump returned to office. According to Reuters, Biden's easing facilitated temporary output recovery to around 800,000 barrels per day. But the gains stalled once sanctions returned. Global trade analysts noted another layer. China's dominance over Venezuelan exports meant Trump's order risked creating diplomatic friction not with Venezuela but with Beijing. Xi Jinping's administration did not publicly comment on the sanctions, but state-linked media framed the energy relationship as mutually beneficial and insulated from external political pressure. The Financial Times cited academics who argued that China's willingness to absorb geopolitical risk stemmed from its long-term energy strategy rather than short-term opportunism. On the ground, the Alula served as the visual symbol of that strategy. With each diagnostic cycle, the platform illuminated more of the lake's darkened surface. Workers monitored the influx of tools, pipes, and equipment arriving at nearby docks. Training modules integrated Chinese drilling software with PDVSA's legacy systems, allowing teams that had worked with outdated analog consoles to transition into digital control environments. As the platform drilled deeper into the initial test well, technicians noticed pressure fluctuations inconsistent with the deterioration models PDVSA had developed in the sanctions era. Older wells often respond sluggishly or unevenly after long periods of inactivity, but these readings showed a far more elastic reservoir response. Bloomberg cited technical notes indicating the pressure curve resembled those recorded before 2019, when the field had significantly higher productivity. That curve produced the final escalation. Analysts within PDVSA recognized it as a signature of reservoir rejuvenation, a sign that layers long sealed by inactivity were rebalancing under renewed extraction. Telechea sent a confidential summary to Maduro outlining the potential implications. If the reservoir's responsiveness continued to increase, production forecasts for the basin would need recalibration across multiple horizons. This did not imply an instant recovery. It implied something subtler yet more destabilizing for the sanctions architecture. The geology itself was shifting faster than the policy mechanisms designed to suffocate it. Xi Jinping's energy advisors received parallel updates. For China, a more responsive Venezuelan reservoir meant supply reliability over the 20-year investment timeline. For Washington, it meant sanctions may no longer correlate with output suppression. According to economists interviewed by Reuters, the greatest uncertainty was now the rate at which field rehabilitation could scale. Night returned to the lake as the Alula prepared its next sequence. The lights cast long reflections across the water, creating an image that looked almost inverted, as if the structure existed in two planes, one above the surface and one beneath. Sensor readings stabilized into a pattern PDVSA had not seen in over half a decade. The curve expanded outward, subtle yet unmistakable. If the next cycle confirmed the signal, it would mean the reservoir was responding not to pressure alone but to the return of an operational ecosystem that sanctions tried to erase. And in that shift lay the possibility that the forces shaping Venezuela's future were no longer written solely in executive orders or diplomatic cables, but in the behavior of a geological body waking from imposed silence, moving beneath a lake that had waited 10 years for its own return to motion. They thought the real danger was the sanctions. They thought the pressure points were political. But as the Alula pushed deeper into the old Venezuelan reservoir, data from its sensors flashed a pattern no analyst had projected. Pressure rising in formations believed to be permanently dormant. The signal hit Beijing and Washington at the same hour, and both teams reached the same conclusion. Someone had miscalculated the limits of this field. Because if these readings hold, Venezuela won't just revive its oil sector, it will unleash a volume shift large enough to distort the global balance of supply itself. And the world's biggest powers are already bracing for what happens when that curve breaks open. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.